Hey there! If you're serious about improving your leadership skills and growing your business, you're in the right place. We bring you practical tips, expert insights, and real-world strategies to help you stay ahead. Hit that subscribe button and let's grow together. And don't forget, your thoughts matter. Drop a comment below and let's discuss. What if you could unravel the secrets behind successful investment strategies and achieve financial freedom? Look no further for the ultimate guide to navigating the complex world of investments. Uncover the essential tactics that can turn your financial dreams into reality. Before diving into the strategies, let's see where you stand. Answer these questions honestly. 1. Do you understand the difference between stocks and bonds? 2. Can you explain what a mutual fund is? 3. Do you know what an ETF, exchange-traded fund is, and how it differs from mutual funds? 4. Are you familiar with the concept of diversification in investing? 5. Do you regularly follow financial news and updates? Keep your answers in mind. By the end of this bookshot, you'll discover how much you've learned and how ready you are to conquer the investment world. Introduction to investment strategies. Investing can be intimidating, but it doesn't have to be. Successful investment strategies are the roadmap to financial security, offering a path to grow your wealth and achieve your goals. Whether you're saving for retirement, buying a home, or building an emergency fund, understanding these strategies is crucial. The importance of a clear investment strategy. Imagine sailing a ship without a map. The open sea is vast, unpredictable, and full of potential dangers. Similarly, navigating the financial markets without a clear strategy is risky and often leads to poor results. A well-defined investment strategy provides a sense of direction, helping you make informed decisions, manage risks, and stay focused on your long-term objectives. The role of financial education. Robert Kiyosaki, the author of Rich Dad, Poor Dad, emphasizes the importance of financial education. He argues that investing in your financial literacy is the first step toward successful investing. Understanding key financial concepts, staying informed about market trends, and continuously learning are vital components of any successful investment strategy. Fundamental investment strategies. Buy and hold. One of the simplest and most effective investment strategies is the buy and hold approach. This strategy involves purchasing high-quality investments and holding them for an extended period, regardless of market fluctuations. The philosophy behind this strategy is that, over time, the market tends to rise, and long-term investments will grow in value. Interesting fact. According to a study by J.P. Morgan, the S&P 500 index has returned an average annual return of about 10% since its inception. Investors who stayed invested during market downturns typically saw their portfolios recover and grow. Dollar cost averaging. Dollar cost averaging is another popular strategy that involves investing a fixed amount of money at regular intervals, regardless of market conditions. This approach helps mitigate the risk of investing a large sum at an inopportune time and allows you to buy more shares when prices are low and fewer shares when prices are high. Tony Robbins, in his book Unshakable, highlights the benefits of dollar cost averaging, noting that it reduces the emotional impact of market volatility and promotes disciplined investing. Diversification. Diversification is a fundamental principle in investing that involves spreading your investments across various asset classes, industries, and geographic regions to reduce risk. By diversifying your portfolio, you minimize the impact of any single investment's poor performance on your overall returns. Value investing. Value investing, popularized by legendary investor Warren Buffett, involves identifying undervalued stocks that have strong fundamentals but are trading below their intrinsic value. This strategy requires thorough research and analysis, but can yield significant returns if executed correctly. Interesting fact. Warren Buffett's company, Berkshire Hathaway, has averaged an annual growth rate of around 20% since 1965, primarily through value investing principles. Growth investing. Growth investing focuses on companies that are expected to grow at an above-average rate compared to other companies in the market. These companies often reinvest their earnings into expansion, research, and development, which can lead to substantial capital appreciation over time. Advanced investment strategies. Index fund investing. Index funds are mutual funds or ETFs designed to replicate the performance of a specific market index, such as the S&P 500. This strategy is ideal for investors seeking broad market exposure with low fees and minimal effort. Jack Bogle, the founder of Vanguard, was a strong advocate for index fund investing, arguing that it consistently outperforms actively managed funds over the long term. Dividend investing. Dividend investing involves purchasing stocks that pay regular dividends. These stocks provide a steady income stream and can be particularly attractive for retirees or those seeking passive income. Reinvesting dividends can also lead to significant growth over time through the power of compounding. Real estate investment. Investing in real estate can be a lucrative strategy, offering both income and capital appreciation. Whether through rental properties, real estate investment trusts, REITs, or property flipping, real estate can diversify your portfolio and provide a hedge against inflation. Options trading. Options trading is a more advanced strategy that involves buying and selling options contracts. Options can be used to hedge against potential losses, generate income, or speculate on market movements. This strategy requires a deep understanding of the market and a higher risk tolerance. Building a successful investment portfolio. Setting clear goals. Before you start investing, it's crucial to define your financial goals. Are you saving for retirement, a down payment on a house, or your children's education? Your goals will influence your investment strategy, risk tolerance, and time horizon. Understanding your risk tolerance. Risk tolerance refers to your ability and willingness to endure market volatility and potential losses. Understanding your risk tolerance helps you choose investments that align with your comfort level and financial situation. Asset allocation. Asset allocation is the process of dividing your investments among different asset classes, such as stocks, bonds, and real estate. The right mix of assets depends on your goals, risk tolerance, and time horizon. A well-balanced portfolio maximizes returns while minimizing risk. Regular portfolio review. Regularly reviewing and rebalancing your portfolio ensures that your investments remain aligned with your goals and risk tolerance. This involves selling overperforming assets and buying underperforming ones to maintain your desired asset allocation. Learning from the experts. Insights from Robert Kiyosaki. Robert Kiyosaki, a prominent figure in personal finance education, has influenced millions with his unconventional approach to wealth building. Central to Kiyosaki's philosophy is the belief that financial success is achievable through financial education and strategic investment choices. He posits that the traditional path of working a 9-to-5 job and saving money is insufficient for achieving financial independence. Instead, he advocates for a proactive approach that involves acquiring assets that generate passive income. The 4 quadrants of income. In his groundbreaking book, Rich Dad, Poor Dad, Kiyosaki introduces the concept of the cash flow quadrant, which categorizes income sources into 4 quadrants: employee, E, self-employed, S, business owner, B, and investor, I. According to Kiyosaki, the key to financial freedom lies in transitioning from the left side of the quadrant, E and S, to the right side, B and I. This shift involves moving away from earning income through labor and towards earning income through ownership of businesses and investments. Interesting fact: Kiyosaki's insights have been translated into 51 languages and sold over 41 million copies worldwide, highlighting the global impact of his financial teachings. Emphasizing passive income. Kiyosaki's emphasis on passive income is a cornerstone of his investment strategy. Passive income is money earned with minimal effort, allowing you to make money while you sleep. He encourages investors to focus on acquiring assets such as rental properties, dividend-paying stocks, and intellectual property that generate consistent cash flow. By building multiple streams of passive income, you can achieve financial security and independence. The importance of financial education. Kiyosaki firmly believes that financial education is the foundation of successful investing. He argues that most people are not taught about money in school, which leaves them ill-equipped to handle their finances. To bridge this gap, Kiyosaki advocates for self-education through books, seminars, and courses. He stresses the importance of understanding financial statements, market trends, and investment opportunities to make informed decisions. Leverage and risk management. Another key insight from Kiyosaki is the use of leverage and risk management in investing. Leverage involves using borrowed capital to increase the potential return on investment. While leverage can amplify gains, it also increases risk. Kiyosaki advises investors to manage risk through proper education, strategic planning, and diversification. By understanding and controlling risk, you can use leverage effectively to enhance your investment returns. Real estate investment. Kiyosaki is a strong proponent of real estate investment. He views real estate as a tangible asset that can provide steady income through rental payments and potential appreciation over time. Kiyosaki's approach to real estate involves thorough market research, identifying undervalued properties, and leveraging financing options to maximize returns. He believes that real estate is a reliable way to build wealth and achieve financial independence. Insights from Guide to Investing. Understanding Kiyosaki's Investment Philosophy. Guide to Investing by Robert Kiyosaki delves deeper into his investment philosophy, offering practical advice and strategies for aspiring investors. The book emphasizes the importance of adopting a mindset geared towards wealth creation and highlights the differences between rich and poor investors. The 3 E's: education, experience, and excess cash. Kiyosaki introduces the concept of the 3 E's: education, experience, and excess cash as essential components of successful investing. He argues that a solid education in financial principles is the foundation of intelligent investing. Experience, gained through real-world practice and learning from successes and failures, refines your investment skills. Excess cash, or disposable income, is necessary to seize investment opportunities without jeopardizing your financial stability. The power of leverage. In Guide to Investing, Kiyosaki elaborates on the use of leverage to accelerate wealth building. He explains how to use other people's money, OPM, to invest in assets that generate cash flow. This includes taking out loans to purchase real estate or using margin to buy stocks. Kiyosaki emphasizes the importance of understanding the risks associated with leverage and using it judiciously to maximize returns. The investor's business plan. Kiyosaki stresses the importance of creating an investor's business plan. This plan outlines your financial goals, investment strategy, risk tolerance, and action steps. A well-crafted business plan serves as a roadmap, guiding your investment decisions and helping you stay focused on your long-term objectives. Kiyosaki provides templates and examples in the book to help readers develop their personalized business plans. Investing in yourself. One of the most compelling messages in Guide to Investing is the importance of investing in yourself. Kiyosaki believes that your most valuable asset is your mind. By continuously improving your financial knowledge and skills, you enhance your ability to make smart investment decisions. He encourages readers to seek mentors, attend workshops, and read extensively to stay ahead in the investment game. The role of taxes in investing. Kiyosaki also addresses the role of taxes in investing. He explains how understanding tax laws and using legal tax shelters can significantly impact your investment returns. By structuring your investments to minimize taxes, you can retain more of your earnings and accelerate your wealth-building process. The rich investor's mindset. Finally, Guide to Investing delves into the mindset of a rich investor. Kiyosaki emphasizes the importance of thinking like an entrepreneur and viewing investments as businesses. This mindset involves being proactive, taking calculated risks, and constantly seeking opportunities for growth. Kiyosaki encourages readers to adopt a long-term perspective and remain resilient in the face of challenges. Applying Kiyosaki's insights to your investment journey. Develop a financial education plan. Start by committing to your financial education. Read books, attend seminars, and take courses to build your knowledge base. Understanding financial statements, market dynamics, and investment principles is crucial to making informed decisions. Focus on passive income. Identify assets that can generate passive income. This could include rental properties, dividend-paying stocks, or creating intellectual property. Aim to build multiple streams of passive income to achieve financial stability and independence. Leverage wisely. Use leverage strategically to enhance your investment returns. Understand the risks involved and develop a risk management plan. Leverage can be a powerful tool if used correctly, but it requires careful planning and education. Create an investor's business plan. Develop a detailed investor's business plan outlining your financial goals, investment strategy, and risk tolerance. Use this plan as a guide to stay focused and make disciplined investment decisions. Think like an entrepreneur. Adopt the mindset of a rich investor by thinking like an entrepreneur. Be proactive in seeking investment opportunities, take calculated risks, and focus on long-term growth. View your investments as businesses and continuously seek ways to improve and expand your portfolio. Understand taxes. Educate yourself on tax laws and strategies to minimize your tax burden legally. Effective tax planning can significantly impact your investment returns and accelerate your wealth-building process. By incorporating these insights from Robert Kiyosaki and his Guide to Investing, you can develop a robust investment strategy that aligns with your financial goals and propels you towards financial freedom. Remember, the journey to wealth is a continuous learning process that requires dedication, resilience, and a proactive mindset. Tony Robbins' advice. Tony Robbins advocates for a diversified portfolio and a long-term investment approach. In Money Master the Game, Robbins interviews some of the world's top investors, who consistently highlight the importance of diversification, low-cost index funds, and disciplined investing. Key takeaways from A Beginner's Guide to the Stock Market. A Beginner's Guide to the Stock Market by Matthew R. Crater is an excellent resource for novice investors. The book simplifies complex concepts, providing practical advice on how to start investing, avoid common mistakes, and develop a winning strategy. Key takeaways include the importance of starting early, investing regularly, and staying informed about market trends. Lessons from The Simple Path to Wealth. J.L. Collins. The Simple Path to Wealth offers straightforward advice on achieving financial independence. Collins advocates for investing in low-cost index funds, living below your means, and avoiding debt. His emphasis on simplicity and long-term thinking resonates with both novice and experienced investors. Applying these strategies in real life. Start early and invest regularly. The power of compounding cannot be overstated. Starting early and investing regularly allows your investments to grow exponentially over time. Even small contributions can lead to substantial wealth accumulation if given enough time. Stay informed and keep learning. The financial markets are constantly evolving. Staying informed about market trends, economic indicators, and new investment opportunities is crucial. Continuously educating yourself through books, courses, and reputable financial news sources will keep you ahead of the curve. Be disciplined and patient. Investing is a marathon, not a sprint. It requires discipline and patience, especially during market downturns. Avoid the temptation to make impulsive decisions based on short-term market fluctuations. Stick to your strategy and focus on your long-term goals. Seek professional advice. If you're unsure about your investment strategy or need personalized guidance, consider seeking advice from a certified financial planner or investment advisor. A professional can help you develop a tailored plan that aligns with your goals and risk tolerance. Conclusion: your path to financial freedom. Investing can be daunting, but with the right strategies and mindset, anyone can achieve financial success. Let's recap the key points. A clear investment strategy provides direction and helps manage risk. Financial education is the foundation of successful investing. Fundamental strategies like buy and hold, dollar cost averaging, and diversification are essential. Advanced strategies like index fund investing, dividend investing, and real estate can enhance your portfolio. Setting clear goals, understanding your risk tolerance, and regularly reviewing your portfolio are crucial steps. Insights from experts like Robert Kiyosaki and Tony Robbins offer valuable guidance. Practical advice from books like A Beginner's Guide to the Stock Market and The Simple Path to Wealth can be applied to your investment journey. Results of the Investment Knowledge Test. Now, let's see how you did on the Investment Knowledge Test. 1. Understanding the difference between stocks and bonds. Stocks represent ownership in a company, while bonds are loans to a company or government. 2. Mutual funds. These are investment vehicles that pool money from many investors to purchase a diversified portfolio of securities. 3. ETFs, exchange-traded funds. Similar to mutual funds but traded on stock exchanges like individual stocks. 4. Diversification, spreading investments across various assets to reduce risk. 5. Following financial news. Staying informed is key to making informed investment decisions. Start your investment journey today. Educate yourself, develop a clear strategy, and take action. The road to financial freedom begins with a single step, and the sooner you start, the closer you'll get to achieving your goals. Remember, successful investing is about discipline, patience, and continuous learning. Embrace the journey and watch your wealth grow. With these insights and strategies, you are well equipped to navigate the world of investing and achieve financial success. Happy investing. If today's insights helped you, imagine what consistent learning can do for your growth. Hit subscribe, turn on notifications, and stay ahead of the game. Let us know your biggest takeaway in the comments. Until next time, stay sharp, stay ambitious, and keep leading. Want more? We've got you covered. Click the link below and get even deeper insights. No cost, just value.